How the Fed just rigged the gold and silver market somewhere inside a quiet room in Washington. A decision is being made that most investors will never see coming. The markets think they know what happens next. Wall Street has already placed its bets, but what if the entire financial world has been reading the wrong signal? What if the next move by the Federal Reserve isn't the one everyone is pricing in? And what if that single miscalculation is about to reshape the value of gold and silver for the rest of this year? Somebody is wrong. And by the end of this video, you will know exactly who. Welcome back to Precious Metals Intelligence, the channel dedicated to breaking down the economic forces that quietly shape the value of real, tangible wealth. Before we begin, a respectful request. If you find value in this kind of measured, fact-driven analysis, consider joining this community by subscribing. This channel is built for people who prefer clarity over noise, for those who have lived through enough market cycles to know that patience and preparation matter more than panic. In the final days of June, something strange was happening in the world of money. Almost every trader, every bank, and every major financial institution believed the same thing. They believed the Federal Reserve was about to cut interest rates before the end of the year. This belief was not just a guess. It was priced into the market. Contracts tied to future interest rates showed that traders were placing near unanimous bets on a rate cut. Some reports showed that only 1 in 5 people even considered the idea that rates might stay the same. That kind of agreement is rare in financial markets. Usually, opinions are split. Some analysts expect one outcome, others expect the opposite. But this time, almost everyone was standing on the same side of the boat. And when that happens, history has shown one thing again and again. When too many people believe the same outcome is certain, the market becomes fragile. It only takes one surprise to shake the entire system. That surprise may already be forming. Behind the scenes, a specialist commodities research group made a bold and uncomfortable claim. They said the Federal Reserve was more likely to leave interest rates unchanged for the rest of the year than to cut them as most traders expected. This was not a small technical detail. It was a direct challenge to what almost the entire financial world believed. If this group was right, then the market had made a serious mistake. And mistakes like this do not stay hidden for long. Eventually, the truth comes out, and prices adjust to match reality. To understand why this matters so much, it helps to think about how interest rates affect gold and silver. When interest rates are expected to fall, gold and silver often become more attractive. This is because these metals do not pay interest like a savings account or a bond does. So when interest rates drop, the cost of holding gold and silver instead of cash becomes smaller. Investors feel more comfortable holding metals when borrowing money is cheap and returns on cash are low. But if the Federal Reserve chooses not to cut rates and instead keeps them exactly where they are, this comfortable assumption breaks down. Traders who position themselves for a rate cut may suddenly find themselves on the wrong side of the market. And when that happens, prices can move quickly and not always in the direction people expect. This is the heart of the situation. Not a hidden conspiracy, not a secret plan whispered in a locked room. Instead, it is something more dangerous in some ways, because it hides in plain sight. It is a market that has convinced itself of one outcome, while the actual data points towards something else entirely. Inflation remains a serious concern. Prices for everyday goods and services have not cooled down as quickly as many hoped. At the same time, the Federal Reserve faces pressure not to raise rates too aggressively, because doing so risks slowing down the entire economy. This creates a difficult balancing act. Cutting rates could allow inflation to rise further. Raising rates could weaken economic growth. Standing still, doing nothing, keeping rates exactly where they are, may actually be the path the Federal Reserve prefers, even if almost nobody in the market is prepared for it. This is where gold and silver enter the story in a powerful way. These two metals have spent centuries acting as protection during times of uncertainty. They do not depend on the promises of any single company or government. They do not rely on interest payments or corporate earnings. Their value often rises exactly when trust in financial systems and predictions begins to weaken. So the real question is not whether the Federal Reserve will make a mistake. The real question is whether the market itself has already. To understand what is really happening, people need to step inside the mind of the Federal Reserve for a moment, not as traders, not as analysts chasing the next headline, but as decision makers facing a problem with no easy answer. The Federal Reserve has two jobs that often pull against each other. One job is to keep prices stable, meaning inflation should stay low and controlled. The other job is to support a healthy, growing economy, meaning people should have jobs and businesses should be able to borrow and expand. Most of the time, these two goals work together fine. But right now, they are pulling in opposite directions, and that creates a very uncomfortable position for policymakers. If the Federal Reserve cuts interest rates, borrowing becomes cheaper. Businesses expand faster. People spend more. But inflation, which has already been running above target, could rise even higher. That is a risk almost nobody in power wants to take right now. If the Federal Reserve raises interest rates instead, Inflation could slow down. But raising rates makes borrowing more expensive. Businesses may pull back. Growth may slow. In some cases, this can even push an economy toward a recession. That is an even bigger risk, and one that carries serious political consequences. So there's a third option, one that almost nobody in the market seems to be preparing for. Do nothing. Leave rates exactly where they are. Not a cut, not a hike, just a pause. An extended, quiet pause that allows the Federal Reserve to avoid both dangers at once. This option may not excite traders looking for fast profits, but for policymakers thinking about long-term stability, it may be the smartest and safest path available. It avoids the political backlash of slowing the economy through higher rates. It also avoids the criticism of allowing inflation to spiral further out of control through rate cuts. There's another layer to this story that deserves attention. The relationship between the Federal Reserve and the political environment in Washington is never simple. Historically, presidents have often pushed for lower interest rates because cheaper borrowing tends to boost economic activity in the short term, which can be politically popular. But this situation appears different. There are signs that the current administration may actually be comfortable with interest rates staying exactly where they are, rather than being cut. Why would that be the case? Because a pause, rather than a cut, may serve a bigger purpose. It avoids the appearance of panic. It avoids sending a signal that the economy is in trouble and needs emergency support. A calm, steady pause allows leaders to project confidence, even while inflation remains a real and unresolved concern in the background. This is where the story becomes even more important for everyday people trying to protect their financial future. When interest rate policy becomes tangled with political timing rather than pure economic necessity, predictions become harder to trust. Markets that assume a rate cut is coming may be relying on outdated logic, built on how things worked in the past rather than how they may work this time. And there is one more factor quietly shaping this entire situation: the size of the national debt. The United States is approaching a debt level close to $40 trillion. This is not a small detail. High debt levels change how a country's central bank thinks about interest rates. Higher rates make it more expensive for the government itself to pay interest on its own debt. That adds even more pressure toward keeping rates steady rather than raising them, while also creating hesitation around cutting rates too quickly and appearing reckless with inflation. Put all these pieces together and a clearer picture begins to form. The Federal Reserve may not be trying to please the market's expectations at all. It may be trying to walk a careful, narrow path between inflation, growth, political pressure, and a growing mountain of national debt. If that path leads to an extended pause, rather than the rate cut that almost everyone has been expecting, the consequences will not stay contained to Wall Street trading desks. They will ripple outward, into currency markets, into borrowing costs, and directly into the value of gold and silver. And that ripple may be closer than most people realize. While most traders were busy watching headlines, guessing what the Federal Reserve might do next, a different kind of activity was quietly taking place. It was not loud, it was not dramatic, but it was consistent, and consistency in the world of finance often tells a deeper truth than noise ever can. Central banks around the world had been steadily adding gold to their reserves, not for a single month, not as a one-time reaction to a headline, but month after month, in a pattern that stretched back well beyond the recent uncertainty. Some of the largest economies on Earth continued building their gold holdings, quietly, methodically, without asking permission from the daily swings of the stock market. This is worth pausing on, because central banks are not like everyday traders. They are not trying to make a quick profit before lunch. They are not reacting emotionally to a single piece of economic data. When a central bank decides to increase its gold reserves, it is usually thinking many years ahead, not many days ahead. It is preparing for long-term shifts in currency stability, trust, and global power, not short-term price movements. One nation had reportedly continued its gold-buying streak for 40 consecutive months. Another had added a significant amount in a single month alone. These are not small, symbolic purchases. These are sustained, strategic decisions made by institutions that have access to information and analysis far beyond what an average investor sees on a screen. At the same time, something else was shifting. Investment funds tied directly to gold, the kind that everyday investors can buy and sell easily, began seeing new money flow back in. For weeks, these funds had experienced the opposite. Money had been leaving. But that trend appeared to be reversing, with fresh capital entering gold-backed investments for the first time in several weeks. Why does this matter so much? Because it suggests two very different groups of people may be looking at the same uncertain future and reaching the same conclusion, even if they are arriving there through different paths. Central banks, moving slowly and deliberately, have been accumulating gold for months, and now more everyday investors appear to be starting to follow that same instinct, even before the Federal Reserve has made its next move official. This is often how major shifts begin, not with a single dramatic announcement, but with a quiet accumulation phase that happens before most of the public even notices. By the time a shift becomes obvious to everyone, The early movers have often already secured their position. There's a pattern that tends to repeat throughout financial history. Large, well-informed institutions tend to act early and quietly. Retail investors, everyday people managing their own savings and future, tend to act later, often after prices have already begun to move. This gap between early institutional action and later public awareness is where much of the opportunity and much of the risk tends to live. If the Federal Reserve does eventually confirm what some analysts have already suspected, that rates will remain unchanged rather than being cut as the majority expected, the shift in gold and silver prices may not happen slowly. It may happen quickly, as the broader market rushes to catch up with a reality that select institutions had already been quietly preparing for. This is not about panic, it is about paying attention to patterns that are easy to overlook when daily headlines are focused elsewhere, on geopolitical tension, on stock market highs, or on short-term political statements. The steady accumulation of gold by central banks, combined with a slow return of investor confidence in gold-backed funds, tells a story that numbers alone can reveal, even when the broader conversation has not yet caught up. For those paying close attention, this is the moment where preparation matters more than prediction. It is not about knowing exactly what will happen next week. It is about understanding that the foundation for a major shift may already be forming quietly beneath the surface of daily market noise. And, as the next part of this story will show, it is not only monetary policy shaping this outcome. There is another powerful force at work, one tied to global stability itself, and it may be accelerating this shift faster than anyone expected. Money does not move in isolation. It responds to fear, to uncertainty, and to events that have nothing to do with interest rates on paper, yet everything to do with how people feel about the future. And right now, beyond the walls of the Federal Reserve, another force has been quietly building, one tied not to policy meetings, but to global stability itself. Tensions in the Middle East have added a layer of pressure that few traders were fully prepared for. Reports of renewed military activity, combined with concerns over a critical shipping route responsible for a large share of the world's oil transport, sent ripples through energy markets. When oil supply routes face uncertainty, the effects rarely stay contained to fuel prices alone. They spread outward into shipping costs, into inflation expectations, and into the broader sense of financial security that investors rely on when making decisions. This matters deeply for the story already unfolding around interest rates. Inflation, remember, was one of the key reasons the Federal Reserve may choose to pause rather than cut. Now add rising geopolitical tension into that equation. Conflict near major oil transit points tends to push energy prices upward. Higher energy prices tend to push inflation upward as well. And rising inflation makes it even less likely that the Federal Reserve will feel comfortable cutting interest rates anytime soon. In other words, two separate forces, one coming from domestic monetary policy and one coming from international conflict, appear to be pointing in the same direction at the same time. That kind of alignment does not happen often, and when it does, it tends to carry real weight rather than fading quickly. For decades, gold and silver have played a specific role during moments like this. They are not tied to any single government's promises. They do not depend on the profits of a single company or the health of a single stock exchange. Their value is not controlled by one central bank, one president, or one political party. This independence is exactly why investors have turned to these metals again and again throughout history, whenever trust in traditional financial systems began to weaken. When military tension rises in a region responsible for a significant share of global energy supply, uncertainty does not stay contained to that region alone. It becomes a global concern. Shipping companies grow cautious. Energy markets grow volatile. And investors, sensing that unpredictability, often begin looking for assets that do not depend on any single nation's stability to hold their value. This is not a prediction of war, and it is not meant to create fear for its own sake. It is simply an honest look at how interconnected today's financial system has become. A decision made in Washington about interest rates does not exist separately from a military development thousands of miles away. They influence each other often in ways that are not obvious until the effects appear in prices weeks or months later. Taken together, three forces now appear to be moving in the same direction at once. A Federal Reserve that may be more likely to pause than cut. Central banks quietly and steadily accumulating gold for months. And rising geopolitical tension adding new pressure to inflation and global stability at the very same time. Individually, each of these forces might be manageable. Markets have handled uncertainty before, but when three separate pressures build at once, and when institutional money has already been quietly preparing for months, the eventual adjustment tends to happen quickly rather than gradually. The real question left standing is simple, but important. When the broader market finally catches up to what select institutions and analysts have already been signaling, how much time will everyday investors actually have to respond? That question leads directly into the final part of this story, where all of these threads come together and where the true cost of misreading this moment becomes clear.